Hello, welcome from Trend Signal for our review of the data and events the week beginning the 17th of October. Equity markets were sort of unchanged, mixed really last week. That wasn't the main news last week. The main headlines, apart from being grabbed by Donald Trump as it has been for the last, God, feels like months, doesn't it? No, the main headlines were the dollar's surge against most major currencies, hitting a 7-month high. The euro fell 1.25% against the dollar. Sterling continued to hemorrhage, falling another 2% last week, and so did the yen, actually falling 1.25%. So really, dollar strength across the board. I don't think necessarily down to interest rate expectations. It's now a bit of a shoe-in for December's rate rise in the US, about 65% probability now. No longer a possibility, more likely a probability. But next year's rate rises are not that clear, if indeed we are going to get one at all. So I don't think that's the main reason why the dollar has surged. I think it's more likely the Clinton-Trump ongoing poll ramifications as Trump continues to do his chances no good whatsoever with a fresh string of allegations that he groped or sexually assaulted women following the release of this video early on in the month. Anyway, he's trying anything he can possibly do now, but we do have this debate coming up, I think this Wednesday in the University of Nevada, so we'll see how that goes. But other than that, gold, oil, all those sort of dollar-based commodities haven't been doing particularly well last week, although oil, the fundamentals have obviously turned a little bit, which helped the markets a tad last week. But other than that, really the main news has been sterling, and obviously, and then the ramifications from a collapse in sterling, the threat of more inflation, something that we haven't talked about for a while. In fact, Mark Carney and Mr. Broadbent from the Bank of England are highlighting that quite clearly. And I think they're probably right to do so. They're pointing out the facts, really, that inflation will rise. And they've said on Friday last week that the Bank of England is prepared to tolerate a higher level of inflation. In fact, the Bank of England's latest forecast is for an inflation rise to 2.4% by 2018, which is probably largely due to the weaker pound, but also a general recovery in commodity prices such as oil. So inflation goes up. Is it a worry? Well, I suppose not if you're a saver, maybe. If you're a highly leveraged and long equities or property, then the next 18 months perhaps could be quite interesting. But, you know, in many countries, it's not been inflation, it's deflation, so a lack of inflation, really. The fact is that we haven't been hitting our target of 2%, and the likelihood is that we will now on the back of this. Then the issue is how can the Bank of England demonstrate that it's in control of inflation, which may be tricky, but we'll find out. Let's have a look at the data coming out, because we do have inflation data out. In fact, we had our own reading on Tuesday the 18th. CPI inflation data were expected at plus 0.9%. Last month we had an expectation of plus 0.7%. I think a lot of people were surprised that it came in at plus 0.6%. But I think with the way things are going, that rate is going to pick up, and I wouldn't be surprised to see it match that or even be higher than that. At the moment, markets are reacting quite negatively to this. There's been a general shift in yields higher across European bonds, especially in UK gilts. If we look at the headlines in the FT this Monday afternoon, gilt yields surge over hard Brexit fears. That really has been quite marked over the last week, really. But we've seen yields on UK gilts rise from a low post-Brexit of around sort of 0.5% to 1.1% on Friday last week. In fact, jumping just seven basis points alone on Friday. So, as someone said, a bond that yields something. Wow, that is a shock. So, perhaps getting a little more normal again. But I think sterling and the UK gilt weakness isn't just down to the pound and inflationary expectations. We've already heard and seen the words written hard Brexit, which continues to be mentioned as a possible or likely outcome of negotiations between the UK and the EU. A hard Brexit effectively means that UK takes back control of its borders, laws, etc., but loses its unfettered access to the single market with no compromise on either side. I think that's unlikely, but it's going to be a tough case to get the deal wrapped up as soon as Article 50 is triggered. 2 years with regards to what has to happen could take a long time to get it negotiated, and I'm not sure, and it seems that the FT is not sure that can be done in 2 years. Okay, let's go back to the rest of the calendar. So we discussed the CPI data on Tuesday morning. We also have US inflation data, and it's the core inflation data that we're interested in, plus 0.2%, so in fact lower from the previous month. No price pressures at all in the US whatsoever, so that'll be glossed over. On Wednesday, there's a little bit of data coming out. We've got the Chinese GDP and industrial production data. Continues to be worries in China, especially about the bubble that persists in property and all those loans that go with it. We then have the monthly policy meeting from the Bank of Canada. We're not expecting any change in the overnight rate, plus 0.5%, so no change there. Thursday is probably the biggest day, or most important day. We've got the monthly European Central Bank monetary policy meeting. We're not obviously expecting any change in interest rates, although there is this debate about quantitative easing, and a report did come out a couple of weeks ago, I think it was, discussing tapering its asset management program, which really did spook the markets. So it seems strange now that some are now looking for an extension to this quantitative easing program by 6 months, which is currently set to expire in March 2017. Anyway, we think there will be no change on both fronts, but it's possible that we could see a move on the an extension to the QE program, which would possibly undermine the euro a little bit more. We then have in the afternoon on Thursday the Philly Fed Manufacturing Index. This is the largest sort of district for manufacturing, so it's followed quite closely, but we're looking for a bit of a contraction there. And we've already had some data out, the Empire State Index, which came out on Monday afternoon. As this headline says, it's fallen further into negative territory in October. The Empire State Index, or that's basically New York, whilst it's not such an important manufacturing area, it is probably indicative of what we should be expecting from the Philly Fed Manufacturing Index on Thursday. That's it really. A few central bankers talking. We've got one on the screen here, Kuroda from the Bank of Japan on Friday at some stage. Then we have some CPI data from the Canadian economy and retail sales. But that really wraps it up for the week. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.